Let's just check everybody's in here. Everybody can hear me and see the screen in front of them. They should be able to. Okay, cool. Just a couple of things to note before we get kick-started. Yes, I am going to record the whole webinar. Usually it'll be online within 24 hours, but if you give me 48 just to be on the safe side, because I'm getting somebody else to record it for me. If I record it myself, then my whole PC gets rather slow. So I will send out the recording to everyone as soon as it's done. The other thing I'd say is that you'll note I sent the email out slightly earlier tonight because I realised that some people get a big lag. I just kind of naively thought that when I click send, everybody gets the email within a few minutes. But I've sent some emails out recently that people have got 24 hours later after I've sent it. I don't know whether that's a fault of their end or it's a fault with Google Mail or whatever, but it's obviously a bit disconcerting because I could be, sending this access info out and people might be getting in a few hours, which is completely useless. So if that's happened to anyone before, I do apologise. I don't quite know what's to blame there, but I can see there's quite a few in here, so pretty much everybody's got the email, which is good. Now, today we're going to look at levels, and we're going to look at how to trade levels in a lot of detail. And I've actually divided this into two lessons because there's a huge amount to cover, and there's a lot of different ways to trade a level. And I split my levels into two camps. Those two camps are levels which I'm trading breaks and retests of, and levels where I am going the same way as the traders that traded that level before me. And I'll explain all this in a second. But suffice to say that the second part of this webinar is going to be as important as the first part because there's two different approaches that we take depending on which side of the level that we're on and what participants were doing at that level previously. Now, to get started, whenever we look at a level, I mean, if you've been to my webinar on previous levels, you'll note that we draw levels in on the weekly time frame, the daily time frame, and the hourly time frame. And so what that essentially means is that when you're on the hourly, you're going to see your different levels. Now, the question on everybody's minds when they're trading levels is, well, which levels do I trade, and how do I trade them? So that's what we're gonna look at today. Now, to explain the differences between two different types of levels, I'll illustrate this in charts. What you see is you've got a level up here. This is the US dollar Canadian from a couple of weeks back. We've got a structurally very significant level that the market has been hitting repeatedly. Okay, this obviously forms a structural resistance level. If we actually look back on the daily time frame, we'll see just quite how big that level was. It was prior support. The support level flipped to resistance, and it has been resistance since the beginning of January. So multiple times prices traded into that level. Sellers have hit it, and the offers have been hit. The markets bids have been hit, I should say, and the market is traded off of this level. Now, what we find with these levels is that we're going to get either breakouts when markets trade into these levels. We're going to get breakouts of them, and price is going to keep going, in which case we're going to attempt to sit on the bid in an example like this. When a structural resistance is taken out, we're going to look for price to trade into that level from above, and we're going to sit on the bid. But there could, of course, be a false breakout of a level, in which case price trades through the level. It doesn't close through the level. We get our swing failure pattern, and then we can look for a counter trend trade. Now, before we go into that, one of the important things to remember about my strategy, which kind of is pretty important with regards to these levels, is that I am always buying, okay, I'm always buying below market, and I'm always selling above market. Now, what that means, essentially, is that I'm always going counter to the short-term trade. Short-term trend, I should say. Okay, so I'm if I'm always buying below market, then I'm obviously buying a dip. And if I'm always selling above market, I'm obviously always selling a rally. So that's something to bear in mind. Now, if you take that going forward, if you think about that going forward, you're going to have levels all over your chart. Okay. In this case, I've just marked on the big levels, but you should have level your charts that mark out prior support resistance flips, especially if you've attended the previous webinar on levels. Now, the question then becomes, well, what levels can I trade? Now, if we're buying below market, so take this USD CAD as an example. If we're buying below market, the next level that we come into, or any level that we come into, can only have done one of three things before. Okay, it can either have been resistance, which in this case it has, or it could have been support last, and I'll flip over to another chart, I'll give you an example. So down here, as price is trading down, this is the pound dollar, as price is trading down, this level was support last. Okay, or it could have been that the market has done neither of those things at your level. Perhaps you had a level that was drawn in, that was perhaps significant historically, but recently price has done what we call a wash. It has traded in and out of it and largely ignored it. Now, the first things first, if I've got a level that price has traded in and out of recently, so I always look at the most recent interaction with that level. Okay, I look at the most recent interaction with the level, so I'll always look left and see what price did there recently. Now, if price didn't respect my level recently, then I'm not going to trade at it. It doesn't matter whether it's respected it beautifully in the past, it has to have respected it on the last time that price hit that level. So ruling out the trades where price has washed through levels, so we see price coming into a level, we look left, and last time price chopped in and out of it and didn't respect it. Ruling that out, we can only have two options left. Either, like in this pound dollar, price last found support there when we're trading back down into it, or as in dollar example, price last found resistance. Now, I'm going to concentrate on levels which I call the inverse, i.e. when we're buying, they were levels that price last found resistance at. If we were going to be below market and we're rallying upwards, we're going to be selling levels that price last found support of. So today we're going to concentrate on levels that are the opposite of the intended direction that we're going to be going in. Okay, so which direction are we going in? Well, if we're above market and when the market's falling, we're only going to be buying because I only buy below market. So if we're heading down on the chart, we're looking at levels today that were last resistance, i.e. last the opposite of what we might be planning to do, which is to buy. Now let me explain briefly the reasoning behind the two different approaches. Because you could just say, well, if you've got a level that was support last, why not buy it? Well, what I found is that levels that are structurally significant support, everyone realizes that these are structurally significant support. So what tends to happen is a lot of the traders that have been taught basic support resistance will tend to buy these. As we trade into a level like this in cable, okay, the traders will start to buy. And the more that a support level has been hit, supposedly the stronger it becomes. That's the conventional thinking that traders learn all the time. So the more a support level has been hit, the stronger it becomes. The more resistance level has been hit, the stronger it becomes. So if this has been hit, this cable has been hit 1, 2, 3, and it's been hit 4 times, and it starts to come back for time number 5, a lot of traders are looking at that thinking, well, wow, it's been hit 4 times, it's held every time. It's going to definitely hold on the 5th. It's stronger than ever. And what they tend to do is they tend to buy it with their stop sells obviously below the level. They buy the level. If the level breaks, they're going to stop out. But at the same time, there are what you get, the breakout traders, okay, very, very common strategy. The breakout traders, what they're going to be doing is looking at the level like this, and they're going to be planning to sell it. So what they will do, they will look at all these lows in the same place, and they'll think, right, if cable can get down through here, there's going to be a big breakout, and it's going to collapse. So what they will do is they will put a stop sell order into the market below these lows. Okay, so what this essentially means is when you've got a level that's been hit multiple times, the stop sells are accumulating below. From longs that may need to puke, from short that want to enter the market. Okay, two different groups of traders doing two different things. Some, some getting out of trades that would lose, some entering new trades, but they're both done with stop sells. Okay, or you may even get people hitting market as it goes down through there, but we'll think about the orders for now. Now, what that essentially means is that those traders, because those stop sells are in the market, they are providing liquidity to the bigger traders that need liquidity to enter large positions. Okay, so if there's a lot of sell orders down there, you may get big banks, big traders that push the market down through these areas to trigger the stops. Part of the reason they may do that is because they may start selling ahead of the level to push it down through the level, and then what happens is obviously the further selling from the stop sells makes them money. Okay, so they sell pre-breakout, push it down there, the stops hit in a kind of cascading order, and the price goes lower, and obviously the people that sold originally make money, they sold pre-breakout. You may also get big traders that want to buy down there, and they want to obviously buy into a large amount of selling. Okay, they don't want to buy a big professional that's got to buy a huge amount of the market, particularly in thin markets, doesn't want to buy at a support level, because if he starts to buy at a support level, he's going to get joined by other buyers that see his orders coming in, that see price moving up. They're going to join him. He doesn't want that, because more people vying for his, when he's trying to hit the offers and push the market up, more people hitting those offers is going to push the market higher. He's going to get slipped. So he needs to buy into vast amounts of selling. So the only place that he's selling is when price breaks these lows, okay, because of all the stop orders. So in a nutshell, buying a level that has been hit multiple times is quite, because you're very, very vulnerable to getting seeing price spike against you. Now, if we look at this in a little bit more detail here, we look at cable, zoom out, but you'll see what happens here is that price makes these lows, and price again forms support lows here. For the third time, price forms support here, rallies up, comes down. The fourth time, price finds support and bounces. Then low, we take out all the lows. Now, a lot of people are going to recognize that as a swing failure pattern straight away. But what's happened here is, yes, although if you look at that with the bigger picture and say, well, yeah, okay, support level did hold. We can all kind of agree, basically, that support level held. But the fact of the matter is, if you bought that support level, price squeezed 70 ticks against you in the active session. Okay, that level's around 40s, and the low of this candle is 52.70s. So price squeezed around 70 pips against you. And that's obviously going to take out a lot of the short-termers. All right, so why do you want to buy if you're going to get a squeeze? You buy the support, you're very vulnerable to getting that squeeze, because it often happens. So if we're going to buy a level where we're going the same way as traders before us, then it's a completely, I look for a completely different thing. I have to be very, very mindful of the fact that I may get stop hunted, and I want to wait for the stop hunt to take place and then trade. But it's a different process. Okay. Now that's what I want to concentrate in the second webinar. What I want to concentrate on tonight is trading levels where participants were last doing the opposite to what we're about to do. Okay. And the easy way to think of that is breakout trades. Where basically, how do we trade when there has been a genuine breakout of a level? Okay, so what do we look for in terms of the level, and what do we look for in terms of how price trades into it? Well, the first thing that we have to think about, okay, with our levels, is we have to identify how strong the level is. So remember, just to recap, we're only talking about levels which have last done the opposite to what we are about to do. We're buying below market, so we need levels that will last resistance. Okay, so how strong is this level, and how can we quantify if the level is strong or not? Well, there's a few ways in which I do it. One of the ways in which I do it to see how strong the level is I look at the number of touches that the level has had. Obviously, if it's had it's been touched 2 times and twice it's formed resistance, then that's strong. But a level that's been hit 3 times and found resistance is stronger. Stands to reason. The more touches before we break out, the stronger that level is. Okay, that's one element. But the second element is I quite like the touches to have occurred over a period of time. And one of the ways in which that happens is if each touch of the level has caused a fairly decent swing away from price, because the further we swing away from the level, supposedly, and it's not going to be every time, but supposedly the longer it's going to take to get back there. The further we swing away, the longer it takes to get back. So I like to see levels where prices hit them multiple times, and each time prices swung away quite significantly before it has come back to the level. And we see that in this US dollar Canadian, it's on an hourly chart, on three occasions, 1, 2, 3, the market has swung away from this area significantly. Note how on the last touch, although yes, technically this is a 4-touch level, on the last touch, there wasn't a big swing away. So the first thing we need to get in our minds is kind of quantifying the number of touches that the level's had, because that's very important to how I'm going to trade it. So we can account the number of touches, but what we're going to do is we're not going to count every single touch. We're going to count only the number of touches that caused the big swing away. So to me, this level is going to be a 3-touch level. 1 here, 2 there, and 3 there. Okay, I'm not going to include this last touch. Now, you might look at that and say, well, if we zoom in on that level for a second, if you actually counted the touches, you'd say, you see this cluster here, which I'm calling 1, you'd actually see that the candles touched it 3 times, 1, 2, 3. Okay, but we're not going to count every single touch. We're going to count them as basically clusters. They're like swing touches. This is basically 1 touch that causes a swing away. Again, this one up here, we move slightly on to the right, this level was actually hit 1, 2, 3 times again, but it just basically caused 1 swing touch away from that area. So we come up with a number of how many touches it's had. And ideally, we like the swings to have been quite deep so that some time has gone by and some space has gone by between each touch. Okay? The longer that the level has developed, the stronger it becomes. A level that has formed over a week is obviously stronger than a level that has formed over the last trading day. So it's number of touches, but it's also time. Now, what I'm looking for is I'm looking for price to take out this level. And when it takes out the level, I'm looking to bid for it back at the level that we've broken out of. So in this example, what we're looking to do is we're looking to bid for USD CAD back at this level. Okay, it's a straightforward break and it's a straightforward retest. Now, the reason that I mentioned about it being important to remember which levels are the inverse are that sometimes the market doesn't come back immediately. Okay, in this example of dollar CAD, it's very straightforward. We break out, we come back pretty quickly. There's not that long to wait before we come back and we get our trade. But sometimes the market takes a long while to come back. But we've got to remember that if we're trading a level that was the inverse line, at some point it was a breakout. So it doesn't matter how long it takes, we're attempting to trade a level that was at one point a breakout, and we're just attempting to get on board that breakout. I'll give you a quick of what I mean by this. I have got an order in, this is a live market order at the moment, to sell gold. Okay, so you can follow this trade through live and see how it pans out. Sod's law, it won't work now. But I've got an order in to sell gold live, and this order is at 1624s. Okay. Now, if we look at this level here, what we're going to see is that this illustrates purposes that we've just, or the rationale that we've just talked about in dollar Canadian. Okay, we've got a level that's been hit once, level that's been hit twice, level that's been hit 3 times, and the market breaks through this area. Okay, now, if what you'll notice here is that a lot of time has gone by. Okay, still haven't gone back to that level. Now, you might forget that we're trading a breakout there, but we're not. You know, we are still trading a breakout. So it's not something that you want to forget. What we're doing is that we're still trying to trade that breakout. Okay, but obviously price hasn't got back there, but it's still a level structurally very strong support. And what was once strong support is likely to flip, and we're likely to find resistance there. So we're asking ourselves the question of, remember, we always sell above market. So if we sell above market, where are those levels that the inverse last? We need to sell a prior support level. We need to go the opposite way to traders before us. Okay? Now, what you'll find is that all the way up on this chart, where we are now currently in gold, there is no level above market that was support last. Every level chart, in my opinion, is resistance last. Every level that you could conceivably draw here is resistance last. Okay, if you're talking about this level here, it's resistance last. It's not the inverse last. Okay, if we're talking about level a little bit lower down, okay, this isn't even a tradable level for me. Why? Because at the beginning of the webinar, we said that when we look left on the last touch, we want to have seen the market respect it, and it didn't. It traded right in and out of it. Okay, so looking for levels that were the inverse last. Now again, noting in this particular example, note the fact that the level is formed, or the level is composed of sizable rallies. Okay, the market has rallied sizably away from these areas. This is actually enough to call this a third touch at this point. It doesn't quite hit it. It's close enough to call that a third touch. And here again, not a massive rally. The other three were. And what we can see is that because of the strict rallies, that level formed over a nice period of time. Okay, the level started forming around the 20th of April, and it was still forming on the 8th of May. It was going on for some time. Okay, I'll answer questions at the end, so in the recording it doesn't look like we're stopping and starting. So if you've got questions, leave them to the end, and I'll make sure I answer them all. But in this particular example, like I say, we're looking to, I'm looking to sell gold at 1624. It's exactly the same as the dollar CAD. I was looking to buy this when we broke out. The only difference between the two is the fact that dollar CAD has come back quickly, whereas the gold hasn't come back yet. Okay, so we're marking in levels and looking at levels that were the inverse last. Now, as I said, what we want to do is quantify the level, and we want to look at how many touches that level has had last. Now, I will have a general rule of thumb, okay, that if the more touches, the better. Obviously, it makes the level stronger. If the level has had 3 touches or more, 3 swing touches, then I will trade it blind. Now, what I mean by blind is I will literally just leave an order in at that level with a stop and a target, which we're not going to get into today, but I will leave an order in. So as dollar Canadian is breaking out here, and as it is moving higher, I'm simply putting a bid in at 153s. Okay? Fairly straightforward. Now, the question comes into play when you've got levels that have less than 3 touches. Because the less touches, the weaker it is. And we don't really want to trade weak levels. However, there are times when you can. Now, I use factors of confluence to help me make trading decisions. And as a general rule of thumb, if I've got 3 touches or more, as I say, I will trade it blind. If I've got 2 touches last, then I'm going to want one factor of confluence. I'm going to want something else to tell me that price is likely to turn at that level. Now, if I've only got a level that's a 1 touch last, literally just it was a prior swing high, then I'm going to need a lot of confluence, generally 2, at least 2 elements of confluence to tell me to take the trade. And confluence is other things. It might be a moving average. It might be a fib level. We'll get onto that in a minute. Okay, but something else other than the level, because the level's not strong enough to take on its own. Now, firstly, let's look at what constitutes, before we look at the number of touches and what confluence we might need, let's look at what constitutes actually a viable trade for me. Okay, so first off, when I'm taking a trade like this, okay, I want to see that there was space between the point at which we broke that level and the point at which we come back to it. This is really, really important to me, to get that element of space. So when we break a level, I don't want to be sitting on the bid until we've continued going higher, okay? And therefore, when we come back, we've got an element of space. A lot of people do trade what we call the immediate retest. Some people call it the butt kiss, which is when literally the first close above that area, you sit on the bid. Now, I found that not to be so reliable. And I think part of the reason for that is, especially because I'm trading on the hourly time frame, the longer it stays above the level and the higher it keeps going, the more likely it is to establish itself as a breakout on a higher time frame, meaning that the higher time frame traders see it. Okay, so it's important to me to have this element of space. The second element that's quite important is I like to see momentum into my level. Okay, it's one of the things I really, really like to see. So if I'm buying a level, I like to see the market heading into it quite hard. And that's quite counterintuitive because a lot of people see the market nosediving like this and they get nervous about standing in front of it. You know, all those sayings about don't catch a falling knife come into play. But I found that it's a lot safer to buy a level if the market is coming down into it quite aggressively than it is to buy a level if the market is drifting slowly into it. Again, very counterintuitive, but it works quite nicely. So it's not a must that the market has got to come into it, but I come into it hard. But I certainly like it if the market is trading, and I'm certainly not scared of it. You know, if the market is coming hard into a good area like this, I will stand in front of it with a limit buy order at this particular level. Okay, and we're looking for this space. Now, to quantify, I get a lot of questions about space. How much space do we need? How many bars makes up that space? And to be honest with you, it's not something that you can quantify. I've never been able to look at it and say, right, you need at least 10 bars before we come back or anything like that. What I'm generally, like I say, I'm generally getting a feel for the price action, and I want to see that the market has broken above the level and that it has basically closed above the level. It's thrust through the level, closed above the level on my hourly time frame, and it's kept going. Okay, the higher it's kept going, the more chance that you've got of space. What you've got here is about anything more than this is perfect, but this is very nice. This is about the minimum amount that I want on a trade. It's just got some, it's stayed out there, and you've got a nice amount of space here. Okay, now what we have to be careful of is if the market bounced just before our level, I won't take the trade. So what I don't like to see is if the market broke out of this level, came back round to it and just missed me, so I didn't get filled, it perhaps didn't quite hit back at my level, then tried to bounce slightly and came right back to my level quickly, then I wouldn't take the trade. So I don't like to see that the market has, that I've missed the trade, that it hasn't quite hit my level, that it's bounced and then comes straight back there. If it comes straight back there, it's a sign that the market is not done with that level. So, like I say, we want it quite clean. The nicest trades are where we break through and we just keep going. Okay, you don't really want to see it break through, then retest, then go, then come back. Okay, I don't really like any interaction with my level at all when we break out. I just want it to go, and I want it to go cleanly. So this CAD, very, very nice example of where we would sit back on the bid. Now, if we flip over and have a look now at a different market, which is the Bund. Again, this is a nice example of how I would trade this particular level. We've got 143.03s in this Bund. And what you can see is you've got a 3-touch level. So again, you've priced it once and it's swung away. Price has hit it again, it has swung away. Price has come up there, and for a third time, it's pushed away. Even for a fourth time. Again, these swings aren't massive, but we have moved away from this area. Now, whether you trade a level like this is somewhat discretionary, because I do like my levels to have formulated over quite a decent amount of time. And if you actually look at this level, it really only formed over 2 days. It's an hourly level that formed over 2 days. But having said that, the touches are nice enough that they cause nice enough swings, and they're clean enough that this can be traded when we get back there. Again, we look for the break, we look for the retest with space, and then when it comes back to that area, we're looking to get long. Now, the targets that you on these trades and the stops, so again, something we get into in later webinars, but suffice to say at the moment, what we're looking for is we're looking to buy a level like this. Now, if you see, and this is a point that again, I'll keep mentioning this point, if you see the market, if you've got a level like this, and you see the market break out, then you know it's quite simple that you're looking to get long when the market pulls back into this area. But what you've got to remember is that there will be many levels, like I said, like in gold, that you forget are breakouts. They will just on your charts as levels that were the inverse last. But I always use the same principle. If it's had 3 touches over a significant period of time and the rallies or the dips have been sizable, then I will trade it. And I will trade it blind. I will need no confirmation. I will just leave an order in, put a stop, and go for a target. And those are the nicest, highest probability trades you can get. Okay, they work very, very well. Now, what I want to look at next is what happens, okay, if you get a level. Pull up another chart for this. Okay. Okay, so what I want to look at next is what happens if you get a level that hasn't had 3 touches, because we know those are the strongest. Now, I'm using here of silver. Now, how do we quantify, firstly, whether this is a strong level? Well, we need to count the number of touches, as we said. Now, this is interesting because at first glance, you would say that's been a 3-touch level. Okay, I personally call that a 2-touch level. Why? Because these 2 touches were very, very close together, and the first touch didn't really create any kind of swing. Okay, it was only the second touch here that created a nice sizable swing. They traded up there again, and we get a fairly decent swing away. So I would call that a 2-touch level. Now, when we break out and we pull back to this level, the question is, can we trade it? Now, my rules clearly state to me, because I found they have the best chance of success in the long term, is that if it's a 3-touch, I'll trade it blind. If it's a 2-touch, I'm going to need something else to tell me to take that trade. And there's 3 factors of confluence I use, and those are what I'm going to go through now. So, the 3 factors of confluence are, I can either have a daily bias, okay, which means that on the daily time frame chart, note this is an hourly, on the daily time frame chart, I have a clear idea of where this market is going to go. Okay, that would be the first. The second factor of confluence that I might have is a Fibonacci level. And the third is going to be the market trading at or over its ATR, which is its average true range. And I'm going to explain all of these principles now. So look at this silver. And the first thing I think to myself is, well, we've got a 2-touch level. Therefore, this is not strong enough for me to just sit on the bid here. Okay, I'm going to need something else. Now, if I flip this to the daily time frame, let me zoom in a little bit here. We're going to see that what we've got here is we've got the market was trading in a sideways range. I believe I went over this in the last webinar on directional bias. Okay, so you may recognize this trade. It's a good example. What we've got here is we've got a pin bar, which is also a swing failure. So we've got a kind of crossbar. Okay, we've put in a swing low. The market's broken the swing low, closed above, false broken the lows of the range. When that happens, price is likely to go to the other side of the range. So at this point in time, we've got a strong directional bias that the market is going to move up. Okay, now for me, that is fine as a factor of confluence. If I've got that bias, then that's absolutely fine. But note that the bias for me has to be a pattern on the chart in terms of a bar pattern. Okay, so a bias, and we did go over this in the directional bias webinar, so I'm not going to go over it too much today. But I wouldn't look at this chart and say, when we're looking at it being a two-touch level, I wouldn't look at it and say, oh, well, it's a two-touch level, and I'll buy that level because it's in the market's in a strong uptrend. Okay, that's the thing I do. I have to be able to look at the time frame, the daily time frame, and realize that that market is likely to have a pattern on the daily to suggest that it's going to go. So things like the trend aren't really concerning me. There needs to be a bar pattern. Now, there's 3 bar patterns that I will look for. They will be a bullish or bearish pin bar, and in this case, we know that we've got a bullish pin bar. Okay, they will be a swing failure, so the market breaks a swing low, closes above, or breaks a swing high, closes below, or they will be a bullish or bearish engulfing candle. Now again, like I say, today I don't want to go into that because we've already gone over it before. But if I've got one of those 3 candles on the daily time frame to suggest which way we're going to go, then in the next session, then I'm going to be able to use that as a factor of confluence. So in this particular silver trade, we just scroll back to it. In this particular silver trade, I know that I've got the factor of confluence that I need, which is that we've got a strong daily bias to tell us this is going to go up and it's going to break the extreme end of the range. Now, if we look what happened, again, same story. We break the level, we come back for the retest, and the rest is history. We break up, we get a nice, decent trade there. But it's worth noting a couple of points here. Number one is that that level to me would not be traded if I hadn't had that bias. Okay, it was not strong for me to trade it without that bias. Now, the second thing to note here, as I zoom in here, okay, is does this constitute enough space? I would say, I mean, it's very hit and miss, but if you've got a daily bias, I would say it does. If you've got a good 2-touch level and you've got a daily bias, I'm not obsessed with the amount of space that it takes back there, but you can still see that I like it to have broken, and I still like to have seen it round back to that area. I'm not basically going to trade it the next bar. I'm not going to ever trade the immediate retest. Even with this, yes, there's not a massive amount of space, but we can still see that it does round back to that area. Now, again, with that kind of trade, being a 2-touch level like that, we do need that factor of confidence. Now, let's skip over and have a look at a very old example here. This is Euro Swiss, back when Euro Swiss was actually moving. Now, Euro Swiss here, again, let's assume a few things. Let's assume that this is the current state of play, okay? And we're looking at the market and wondering what we can do. Well, we've got, at this point in time, the market's trading up here. Okay? We're looking at all the levels that are below market. Right, now what we can note is that levels below market, if we're going to buy below market, which is always what I'm doing, we're talking today about buying levels that were resistance last. How many levels below market here are structurally good resistance last? None, basically, which makes this a very easy trade, because where else do you buy on the chart? There is no level here below market, in my opinion, that was resistance last. None, until you get down to 127.24s. Now, when you get to 127.24s, you've got structural resistance last. Okay, now, when you look at this area here, how many touches is this level? Well, it's a very interesting one. I mean, I would look at that and say that that really is a two-touch. Okay, some people might look at it and say, well, this was very, very close and constitute a three-touch. But I would look at that and basically say that that was a two-touch level. The market, again, we include this whole thing as a cluster. It caused one touch, although it was multiple times, it was one swing point before we stopped off, and the second swing point was here, where again we traded down from this level. So I would really call this level a two-touch level. Now, if it's a two-touch level, we need a factor of confluence. Okay, we only need one factor of confluence, but we're going to need something to tell us to take that trade. Now, let's have a look at what we might have. Okay, we could have a daily bias, we could have fib levels, we could have the market trading past its ATR. We've already looked at daily biases, so let's have a look at something different. Let's have a look next at the ATR. And that's quite interesting with Euro Swiss, because nowadays the ATR is 6 pips. But let's have a look back. Now, how I mark the ATR is as follows. What I do is, obviously, we're waiting for to see when it starts getting close to the level. Now, when it starts getting close to the level, we have got to look at the ATR on the day that the market comes into that level. Okay, so you can see here, look how long it takes to get back here, and before eventually it starts to make its way down. Now, what we need to look at is the day that hits this level. What is the ATR? So what I'm going to do is I'm going back and switch it to candles, for those of you that are familiar, and we're going to have a look at the level on the day that it was hit. Okay, now that was here. Okay, now on that day, we want to know what the 20-period ATR is. The easiest way to do this is to go to Insert, Indicators, ATR. Mine's at the top. Okay. Now I'm going to use a 20-period ATR. Okay. The reason I use a 20-period ATR is because there's 20 trading days in a month. So I'm just averaging out the average amount that the market moves on any given day in the last month. And what I'm going to do is I'm going to click OK, and that's going to overlay this volatility, or this volatility line here shows you whether the market's volatile or whether it's less volatile. It's going to give you a number. Okay, you can see the current ATR is 10 pips. 10 pips is what this market has been moving on average over the last 20 days. But we're concerned with the day in question when we came down to this level. Now, what we do is we are going to hover over, okay, the day before, not the day that triggers us or that's likely to trigger us, but the day before. And we're going to see what the ATR is. Okay. Now, if you look left into the indicator window, you're going to see that you've got 123 pips. That is how much the market is moving on average per day during this trade, which was 23rd of February 2011. Okay, so 123 pips. That means that when it has reached 123 pips, either up or down on the day, then it has reached the average amount that it moves in a given day. Now, does that mean it can't go further? No, of course it could. But it's usually a good place. I've noticed a lot of traders will take profits when the market reaches its ATR because it's an average. So if you know that, say, cable only on average moves 100 pips on a day and you get in, it rallies 100 pips, you're looking for a place to take profits. You're probably thinking, well, it's done what it does on average. I'm going to take some profits on the day. So we know that as that market is falling, if it falls 123 pips from the high of the day, from the highest point of the day, it's likely to meet its ATR. And people are likely to take profits. Now, if we hover over the high of that day, the high was 128.31. Okay, so if we take 128.31, okay, we take 128.31 and we take away 123 pips, that is going to give us 127.08. So when the market reaches, I'm going to put this in a different color line, when it reaches 127.08, the market has reached its ATR on the day. Okay, now let's flip back to the hourly. Okay, so we're going back to the 24th of Feb, 2011. So I'm going to zoom out a little bit. Okay, so what this essentially means is that we've pretty much got confluence because we're looking at this level here coming in at 27.24s, and we know that the market reaches its ATR finally below that area, about 16 pips below it, to be reaching its average amount that it moves in a day. Now, is that close enough to call it confluence? I would say yes. Why? Because if you actually look at where the ATR comes in, can you see that you've got actually this little high here, and the first high is in question over here. It's got the lower end of that level that's being provided as confluence. This was the upper part of the level. This is the lower part. And price finding the ATR on that. Now, what were our other series of confluence that we could look at? Well, we could try a fib level. Okay, now if we're going to try and see if there's any fib levels coming in around here, what we're going to do is we're going to fib from lows to highs and see where those fib levels come in. Okay? Well, if you ask me at the end, then I'll answer. But it'll be easier that way. Okay, so what you'll see here is that the market, if you take a fib from low to the highest point before the market began its turn back, so we have to go up to here, then look what we get. The 61% is so bang on the ATR that you can't even see the ATR line I've just drawn in anymore. So it provides perfect confluence at that lower level. Okay, absolutely perfect confluence. So we now know that this red line is a valid. We've got two assumptions to make from here. Either we want to buy the red line because that's where the resistance starts, and we want to make sure we have our stops below the 61 and the ATR because we know they're coming in on the level, or we can try and buy the lower end of, the 61 and the ATR, knowing there's still, that level is still right in the same area. What I will tend to do is I will tend to buy at the level. I always attach the most importance to the levels. So in this case, I'm going to buy at the level. But if we look at what happens here, you'll see that the market actually breaches the level a little way, trades straight into the 61%, straight into the ATR, and then pushes up. Okay, where does it, interestingly enough, where does it push up to before it stalls? Well, look left on the chart. Support once, support twice, support 3 times. Okay, that would be an inverse level. If we're looking at below market, let me take this off the charts for a second. If we're always saying, as we said at the beginning of the webinar, that we buy when market's falling, we sell when it's rallying. So we could say to ourselves, well, why don't we sell 27.11s then? We've got long here. Not only do we take profits, why don't we go short at 127.11? We look left, we know it was and our rules say that we can trade a 3-touch level blind. So why do we not sell it there is the question. Why do we not get short there? Who knows the answer? Okay, exactly. As Carl's saying, there's no distance. It's just come back there straight away. So we haven't really got much space. Okay, now does it work? Well, incidentally, yeah. I mean, it didn't come back down to the low. You had a reaction off there. Levels this good, you usually will get a reaction. But the reason I like the space is because I'm looking for a swing reaction. So a little reaction like this is not really enough for me. I need to know that it's going to hit that level and break a swing low. And obviously, if there's space, to me, I found in my trading that there's a lot more chance that the market is going to make the sustainment. There's space there. Okay, so that's what we look for in these particular trades. Now, let me show you something else. If you look at just that example of Euro Swiss, look what we've got here. We've got level. And again, we grade these levels. Grade them and we see how many touches, how much space comprise them. That tells us whether we can trade them. Okay, so we're above market. We're looking at all our levels that are on our chart. Let's actually draw them. What levels have we actually got on this chart? Well, we've got one here, which is decent support. We've got one here, which was decent resistance. Okay, we're just going to look below market for now. Where else have we got? We've got, I mean, those are probably the two that are closest to market. Good support, good resistance. Okay, so as this price is heading down, could we trade potential support here? Well, that's something that we're going to look at in the next webinar. But today, we're just looking at trading only the inverse, which means as we're coming down here, we're not even thinking about this. We're just thinking about trading the inverse last. Okay, now look what happens. The market comes down, and here's what's interesting. Okay, we miss the level by ticks, and price has a sizable rally. When that happens, I don't get in on the second attempt. Okay, so that's what I was saying about when we cancel the orders. If I miss my level, and if you'd have drawn that fracture higher, actually, you'd have got it bang on. But that's neither here nor there. If we miss the level like that, and price has a sizable rally away from it, then I'm going to cancel the order. And what do I mean by a sizable rally away? Because this often causes some confusion. If it bounces 10 ticks away from your level and comes back, do you pull the order? Well, generally, when you trade, hopefully everyone here is going to have a target. Now, my general rule of thumb is if I miss the trade like this, if it bounces and I'm not filled, if it gets more than 50% to my target, I'm going to pull the order. So I'm not just going to pull it if we bounce 10, 15 pips. But if getting long at 28.85s, I want to get out of this here. It's the next FTA. It's the next trouble area. It's about a 30 pip move that I'm looking for there. It's structurally a strong level. If we bounce and forget 50%, we've gone to the target and gone through it. I'm not going to rebuy that there. Okay, and it's not to say that the level won't work. Is why I'm not going to buy it. But the reason I'm not going to buy it is because if we've missed the level and we've rallied away from it, what are we doing? We're creating a swing point. And if price rallies away from a swing point and comes back to it, what's usually going to happen is what happens here. The market is going to usually try and take out the stops that always accumulate below the swing points. Every amateur, every newbie in the world always puts a stop beyond the swing point, or nearly always. So if we've created a swing point on the chart, I don't want to be buying it back at that level, right on pretty much base if I've missed it by a few ticks, because I'm going to be buying as loads of people are stopping out, which means that although, again, the level did work, look at the squeeze. If you'd have bought that back at the level, would you have made money? Yes, but look at the squeeze that you got. And let's face it, nobody likes getting squeezed. So we don't take these trades if we've missed them, if they've been close. So to summarize, and I'll open this up to some questions now. Maybe you want to start looking through your chart, seeing if you see any trades or any setups that you want to discuss or any questions you've got. But this webinar is essentially the easy one because the second one is when is how basically we trade levels when we're going the same way as the participants last time. These are the easiest trades you can do when the market is trading into the inverse of where it was last. Okay, so when the market comes into a level that was the inverse last, all we're going to do, it's very, very simple. We're going to count the number of touches. If it's a 3-touch inverse, we buy blind. If it's a 2-touch, we're going to need one factor of confluence. That factor might be our daily bias, it might be our ATR, it might be our fib level. If it's a 1-touch last, and we haven't looked at any examples tonight, but if the level is a 1-touch last, I'm going to need 2 factors of confluence to tell me to take that trade. So I might need a fib level and an ATR, or I might need a daily bias and a fib. And all it basically comes down to is that the less significant the level, it stands to reason, the more that you need to tell you that price is going to bounce off that level. Usually you don't need anything with a 3-touch inverse. They work very, very well. We just have to isolate them and trade them. Now, SFPs are not something that are going to be relevant to this because you shouldn't get an SFP at a level if it's been the inverse last. If you get an SFP, a swing failure pattern, it presumes that the level was support last. If you had an SFP down here, then the touch below the level would have been support last. And that's not what we're discussing today. We're looking at just where the level has been the opposite. Okay, so Steve asking about the neckline break on silver. Scroll forward to that. Okay, absolutely perfect example, Steve. Okay, neckline break, we know that the market often retests. Now, the first thing I would do is I would clarify how many touches has this level had. Okay, really to me, I would probably call this a 2-toucher. Probably, I would say, I mean, you hear me saying probably because it is very, very discretionary. Technically, this has had 3 touches. But again, swing touches, I would really call that 2 swings away that comprise the level. So we've got a nice a 2-toucher there, but what we really need is a factor of confluence if it's only a 2-touch level. So we would start looking, I would immediately start looking for confluence. Okay, put in a fib from the swing low to swing high. Well, what you can see is you've got the 38% right there. Right in that area, you've got the 38%. Now, if you've got, we don't even need to put on the ATR now, or look for a daily bias, because we only need one factor of confluence to take into trade. Okay, now, the only thing I would say about this silver trade is I didn't take this trade. And the reason why I didn't take this trade because it bounced before. That occurred just before the level, which again caused quite a sizable rally. And then the market comes back. I don't like it when that happens. But you can see that the premise was get a nice level. If you've got the confluence on it, then you're very likely to see a bounce. But I will use this filter to keep me out. There was also one on gold as well. Just going back to that dollar CAD trade. Okay, what we're going to do with our stop losses, and this is something I've got into before, and I will get into in a lot more detail later, is with our stop losses, what we're always going to try and do is we're going to ask ourselves a question, where my stop loss would be on this tonight, because I will get through this in a lot of detail. But suffice to say that what you want to think about is you want to be as close to market as you can. If you're buying 153s, you want to keep a tight stop. But what I want to ask myself is, am I stopping out into an area where I would still be bullish? That's what I've got to ask myself. So for example, if we know distance flips to support, I've got to look at this level and say, is there any resistance very close to market, but to this level, which price might squeeze towards? If I look a little bit lower, I find more resistance here, a couple of touches here, a touch there, the price backed off. You know, what I want to do is I want to isolate the areas where price might squeeze to at the worst case scenario and put my stop just beneath those. Usually I'll use a candle as a proxy. So I'll place it beneath the candle that opened below and closed above. My most common stop placement is basically below a candle, open below, stopped above. On this closed above. On this it would usually be here. The candle that opened below and closed above the level, but having a stop there, as we said, still takes you slightly into what I would call an area where price could squeeze to. So I'd want to be a little bit lower than that, but not, you know, not too low. There's usually no need for having really, really wide stops. If you've chosen your levels correctly, you shouldn't get squeezed. It may squeeze a little bit in cases like this where there's a lot of highs just beneath the area, but you shouldn't notice a lot of drawdown. That's what's so fantastic about these trades. You don't get a lot of drawdown with them. Okay, so what I start out by doing, to leave you with kind of plan, what I start out by doing is I always look at the market as where it currently is trading. So if we pull up a brand new chart and we look at, say, I don't know, let's have a look at something that's currently, okay, let's have a look at Euro. In fact, Euro Aussie is an interesting one, another market I'm looking at the moment. Okay, let's look at Euro Aussie. Okay, if we look at the levels that are on this chart, if we look at the big levels, well, we've got a level here. Now look at the number of touches on this Euro Aussie. 1, 2, 3. 3 times the market. In fact, you could almost call that a 4th, although they didn't quite reach it. But if they've got very close and done sizable swings away, you can include them. But we've got pretty much a 4-touch level here. Now, what does that mean to me? It means that I'm not buying for sure down there, because guess where all the stops are going to be? I don't want to get squeezed. So I'm not going to buy down there, certainly not blind touch. Whether I buy at all will be revealed in the second webinar, but I'm not going to buy it blind touch for sure, because I'm just going to buy ahead of the stops. That's pointless. But if we were to break down through that level, then obviously this level is going to make a fantastic selling opportunity. Because we're below it and we're rallying up, we're looking left and we're seeing that it was the inverse last with multiple touches. Now, if you look at this market now and ask yourself, well, okay, where could we sell above market? The answer is relatively simple. To me at the moment, there isn't an area on that chart that I would sell that above market. With the theory that we've been looking at today, selling the inverse. If you're selling the inverse, where on this chart was their support last? You've got to go all the way up to here to find support last. And when you look at that, it's basically 1 touch, which is the weakest number of support last. You need 2 factors of confluence to even take that trade. And that's the first area on the chart that was really decent support last. So you get by trading the inverse, you get quite a quick idea of the bigger areas on the chart and what you might do at them. But make no mistake, they are definitely the nicest, highest probability trades you can do when you are looking to sell into a rally that is into prior support. So when you're selling something that is rallying into a level like this, which is prior support. So the highest probability trades you can take, in my opinion, are when price breaks down through an area like this and we sell the rally into this area below with space, and preferably with some momentum coming into it as well. Now, very, very good question, Jazz. Very good question. You're keeping me on my toes here. Here is a level. Okay. 1, 2, 3. And again, this market traded into it, traded through it, then we got the rally. Now, this wasn't clean. A lot of the crosses aren't clean. I actually made money on this just because I use quite a wide stop on the crosses because I don't like them. Usually I wouldn't. Usually I'd be in right close to the price action. But again, looking at the premise that we've just said about stop placement and thinking about stop placement, where would we normally go? Well, normally I would place stop under this candle here. This is the last candle that opened below, closed above the level. But draw a physical stop there. And look what you're stopping out into. A huge cluster of highs. So you've got to go lower because price might squeeze, especially in the crosses. So if you go lower and you use another candle as a proxy, then you have your stop here. And you look at that, and at that point in time, that seems like a stop beneath that candle seems out of the way of the price. And you can see that you very nearly get taken. Very, very nearly. I actually survived on the trade. I didn't get much out of it though, but I survived on it. But again, the crosses are something I always tell people to be careful of. I'm using them just as an example to illustrate a strong level. So the homework for you guys, as it were, is start looking at your levels, and when you're look at where price currently is, and when it's rallying, so when it starts to rally, look at the areas above market that was support last, structurally strong support last. And if the market's falling, look for areas that were structurally strong resistance last, and look to trade off of those areas. No, the crosses, I'm using a cross to basically a name for any, so any pair that's got the dollar in, the USD, any pair that hasn't got the USD in, I'm calling a cross rate. Sorry, I should have made that clearer. Okay, JB, I mean, good question. Price doesn't have to accelerate into a level, but I do like it if it does. And one of the reasons that I actually like it, well, there's two reasons, and both of them are quite counterintuitive. First one is that at the beginning, let's put it up. Okay, so when price accelerates into a level, as we can see happened here, what you often find is you find that a lot of traders take profits. Usually, people take profits quicker if there's faster drops. Maybe that's got something to do with the fact that what's given to you quickly, you're scared might be taken away just as quickly. But I found that, and someone that taught me this style was a big trader that was telling me about these sharp moves, used to say that quicker or much more likely to take profits at the first area if the market is dropping fast. Okay, that's what the pros will do, right? As it's accelerating, they'll do the safe thing and get out of the trade, all right? But what will the amateurs do? The amateurs won't take profits. See, the amateurs are normally always going to be wrong because we know 95% or whatever the figure is lose money. So the amateur that's got short this dollar CAD by some setup, that's found himself short this, is seeing price collapse very, very fast. And what does he do? Well, he doesn't get out, that's for sure. He probably looks at that and thinks, oh, this is it. This is going to go. This is going to completely nosedive now. Look at that huge red candle. And he stays in the trade. And of course, then price comes back on him. You see, what you usually find is that most newer traders confuse a sharp move with a powerful move. They see a big red candle, they think this is it. But again, to me, if price is moving quite quickly, you often find if it trades into a good level that it can have the elastic band effect. If it's drifting into that level, it worries me. Doesn't mean that I won't take the trade, but it's another point to consider. It's a little bit of a cause for concern if we're just slowly drifting into it. Small range bars. Although again, like with anything, you do have to take liquidity into account with this. Because obviously if you're trading in the Asian session, price is probably going to drift. You know, so a drift in the Asian session is not necessarily a problem because that's often what you're going to find is going to happen. But a drift in the key London and European session would concern me a little bit. This level here wasn't really retested late in the session. This was 1 p.m. that this tested this. The FX Pro here is ahead of time. But this was in the active session. Good question from Jeremy. If the level is flipped from support to resistance, do you also count the touches of the level before the flip? No, that's a very good question. No, I don't. I'm only counting what happened last at this level. Let me actually try and find an example. Let me try and draw this because it will be easier. So if we've got a level that looks like this, let me just draw this in. Okay, so if we've got some resistance there, and then let's say the market found some support, say it did this. Okay, excuse my crazy drawing. Right, now as it drops down through here, you've got a level in there that everybody should be able to see. Okay, we've got buying once before, buying over here, a nice little flip between support and resistance. Okay. Now the question is, as it comes back into this area, I think the question Jeremy's asking is this a one touch from the inverse, or do you look at this and call it a two touch because it did it over here as well? I would call that a one touch. Principally being, I'm only concerned with the number of touches recently. The pattern was broken here. It flipped there. So all I want to know is the number of touches recently before price flipped, as it were. So in this example, I would call that a one. So in the next webinar, you're going to get a very detailed plan that I'm going to give you. But in a nutshell, to think about today with your levels, we've really got one touch, two touches, or 3+. Okay? And the question, and these are all with the inverse, okay? With levels that are the inverse last, okay? 1 touch, 2 touch, and 3 plus. And we need to have a plan for each of them, okay? Now, if it's three touches plus the inverse, then I will trade it blind. What blind means is just bang in a limit order. Okay, you can hit it and mark it if you want to be around the PC. I usually do nearly 99% of my trades done with limit orders. Principally because I don't need to sit in front of the PC with a limit order. If I know the level's good, I don't need to hit it and mark it. I'll just trade it. So 3 touch plus, I'm going to just trade it blind. They're the easiest, highest probability kind of trades. 2 touch, I need 1 factor of confluence. Because a 2 touch is still quite strong, but I need something else. Okay, 1 touch, I need 2 factors of confluence. Now, just to remind ourselves what those confluences are, they are a D1 bias. And if you're unsure of the D1 bias, you'll want to look at the last webinar I did on D1 bias, because we had literally the whole webinar, it was on what I call a D1 bias. Okay, the second one is going to be the ATR. If the market is at or past its ATR coming into a level, that's confluence. And the third one is a fib level. If we've got a strong fib level taken from a major swing point, and preferably on the daily, I like to draw my fibs from swing points on the daily. Okay, rather than the hourly. So if I've got that, then I will consider that confluence. Row, I would trade a 1 touch level if we had the confluence behind it. If we had these 2 factors, there will be times when you will see it. Okay, so I'm going to have to call it a night there. But just to answer these questions, the euro-dollar last week, I don't want to confuse this recording by answering that, Jazz. If you email me, I'll answer it. If you email me a chart, I'll answer it. Vias, good question. When price is about to hit a level, as some news is being released, it's limit order in? No. Very good question. No, I don't. I usually, if we're trading very close to a level, just before news, I will take the order out and stick it in as soon as the news is out of the way. I just don't want to get caught on a news spike. Usually I'll give the news 5 minutes. Take it out, put it back in. Okay, Robert's question, am I buying 124.66 on the euro dollar? 2 touches, 79% confluence. I don't use the 79% confluence. So that wouldn't be fib. There's no fib confluence down there for me. I do know the level you're talking about, and I have had an eye on it. Level here. Those of you that are watching this, it's this level here. It's 2 touches. Okay, it's around. I've got mine at around 24.50s. Okay, it is 2 touches. There's no fib confluence for me down there because I don't use the 78% fib confluence. So what I would need down there to get me long would be another one of those of confluence, which could be a daily bias, but more likely to be the ATR. If the market is trading past its ATR coming into this area, then I would trade it. Now, just for those who didn't understand the ATR, we pull up ATR, 20 period, overlay it. Okay, have a look at the latest candle, which is this one here. It'll give you an ATR reading. Okay, on the daily time frame. It'll give you an ATR reading. that ATR reading is 101 pips. Okay, if we fall 101 pips from the high of day into that area, then I would trade that long. But you can see that 101 pips from, say, the current price would put you at 24.13s, way below there. So we're probably going to need to rally a little bit more first. With the fibs, I'm only looking at 38, 50, and 61. Jeremy, trend lines, with trend lines, I do consider them not so much as confluence, but I consider them as levels. But I don't look so much at trend lines. I don't have a great love of trend lines. I would trade a level with a trend line with the same premise as the levels. If it's been hit multiple times, breaks, retests, I would trade it. Crikey, Robert, did you want to ask that question anymore? I just scrolled down. It looks like you've asked it 10 times. Maybe that's my Onnovia. Okay, well, look, as I say, if I've left anything out that you want to know about, just send me an email, because we've obviously next week we've got the free webinar. So I'll be able to go over it, and it'll give us something to talk about. So if you've got questions, definitely they can all be answered. But we'll have to call it a day there. There's the second part of this is going to be when we're trading levels that are, when we're going the same way. So when we're buying a support that was hit as support before. And in the second webinar, what I'm going to do is I'm going to give you a plan. Please don't share this plan with anyone, because it is literally what I call the market blueprints. But it is going to be a literal plan, step by step, of what you do at every single level on the chart. What you do, like a flow chart, basically. And that's going to be literally 1 month from now. So the next special webinar. I will buy support, Row, definitely. I'll buy support, but it's got to set up right. It's got to set up right. Well, that's what we're going to get into. That's one element of it, Row, the SFP, but there's more, because obviously you can have levels just like the inverse. You can have support. If you're buying a support, it might have been hit once before, twice before, 3 times before. Okay, if anyone's got any questions, or like I say, there's something else they want clarification on, just drop me an email and we'll go through it next Sunday. And I'll get the recording out ASAP, guys.